Hey everyone, what's going on and welcome to your Financial Dose. This channel is all about helping you guys master your personal finances. So today, what we're going to be talking about is a follow-up to our RRSP episode, and it's going to be talking about the tax-free saving account, or the TFSA, that we have here in Canada, which is very similar to the Roth account in the States. So if you guys want to know why the TFSA is my favorite investment vehicle, or how the TFSA can actually make you rich, you should stay till the end to make sure you fully understand how this TFSA actually works. So first off, the TFSA was introduced in 2009 by the Canadian federal government. And the point of this introduction was to try and stimulate Canadians to actually save more money. Because I'm not sure if you guys know, but as Canadians are very good at spending, but not the greatest at saving. And our consumer debt levels are very, very high as of 2019. And although this sort of measure came in 10 years ago, the whole purpose was to try and make us save more money and spend less money by giving us certain incentives. Now, the list of incentives that we have for the TFSA are as follows. Any money that you put in the account is after-tax dollars. So let's say you earn a $50,000 salary, you pay $20,000 of taxes, so you have $30,000 left over at the end of the year. Now, out of that $30,000, anything that you put in the TFSA is put in the TFSA, and that's it. Unlike the RRSP, where the government gives you money back for any contribution that you would put, the TFSA uses after-tax dollars. Now, this may seem like it's less beneficial than the RRSP that uses pre-tax dollars or before-tax dollars, but there's a small caveat. When you transact within the TFSA, so if you buy a stock, you make, a $10 profit and you sell the stock, you don't have to pay any income tax on the gains that you make within the account. Also, if you buy bonds, if you buy dividend-paying stocks as well, the coupon payments or the income that you would make from the bond or the dividend payments that you would make from the stock are also not taxed. So you know how if you have a non-registered investing account, you need to fill up some tax forms at the end of every year, and you need to look at the cost base of all the stocks, and you need to see how much profit you've made on every transaction that you've done, and then you have to look at your capital gains and your capital losses at the end of the year, and then you see how much income you actually made. That income then gets added to your income tax. For the TFSA though, none of that is necessary. You can do whatever you want in the account, meaning buy and sell as many times as you want, make money, lose money, it doesn't matter. You don't really need to keep track of anything because you won't be paying income tax on the profits that you make. Also, if you lose money in the account, you can't apply those losses to losses in a non-registered account or some other account. Also, unlike the RSP, which also has the same benefit of if you make a profit within the account, you don't pay taxes. However, when you take money out of the tax-free saving account, you also don't pay taxes. So if, you put $5,000 in today, 30 years later, you're at, $200,000, and you decide to take those $200,000 out of the account all at once, well, you don't have to pay any tax because you contributed after-tax dollars into this account, and the benefit of the account is not having to pay tax on the transactions as well. If you look at the RSP, you don't pay taxes on the transactions, but when you pull the money out, either all at once or, like 20 to 30,000 per year as you wish, you will be paying taxes on any withdrawn amount. So again, the two accounts are similar in the sense where you don't pay taxes within, but when you take the money out, you need to pay tax on the RSP, but on the TFSA, you don't. How does this account work exactly? Well, what happens is that under the tax-free saving account, you can buy, you can put your money in a saving account, you can put your money in a mutual fund, you can put your money in bonds, you can put your money in stocks. So you can buy many different asset classes under the tax-free saving account banner. That's not so much what's important. What's important to look at is the logistics of how this account actually works. So if you were 18 back in 2009, that means that you have the maximum available contribution room or potential contribution room, because for every year that you've been 18 since 2009, you're able to contribute more and more money to the account. So let's say you turned 18 in 2009. After the first year, you could put $5,000. The second year, you can put another $5,000, and so on and so forth. I'll show you the full chart of the amount of contributions that you could do per year, because they do vary based on inflation and based on, I would guess, government policy as well. Because for 1 year, the contribution went from about 5,500 all the way to 10,000. And then the conservatives came in and they reduced the 10,000 limit back down to 5,500. So if you were 18 in 09, the max amount that you can contribute, or the potential contribution, is $63,500. Now let's say you turned 18 2 years ago. Now you have to look at the chart and you say, okay, I was 18 for I turned 18 in 2018, and then I was also 18 plus in 2019. So I have 2 years of contribution. And for those 2 years, you have 55 in 2018 and 6,000 in 2019. So if you sum those two up, you're looking at $11,500 that you can put in your tax-free saving account. And this, just like the RSP, you can carry forward. So if you don't fill in the allocated amount for that year in your TFSA, you can easily just carry it over to the next year and say, well, I'm going to put double the amount in the following year, and that's fine. So if you've never opened up a tax-free saving account, which you absolutely should, you can actually put the complete $63,500 in if you've been 18 since 2009. The other benefit of the TFSA is that, unlike the RSP, you can withdraw your money whenever you want. So if you put money in, you're 18, you put money in when you're 19, but when you're 20, you want to buy a car, well, you can actually take money out of your TFSA and use it to buy the car, and you don't need to pay any taxes on the money that you withdraw. On the flip side, if ever you do go above the contribution limits, you will be charged interest on the amount above, and that interest is very high. So even if you're making a good return in your TFSA, it's never worth it to contribute more than what's allocated to you. And if you guys want to know how much is allocated to you, you can simply go on the CRA's website under your profile, and then you can look at the contribution room in your RSP as well as in your tax-free saving account. Now we're going to talk about how the account works exactly, because yes, it's very nice to say, okay, well, I put money in, I can take money out, but what actually happens when you take the money out? Can you contribute as much? Do you lose room? Do you gain room? How does it work? Let's say you just turned 18 in 2019 and the contribution room is $6,000. Since you're an avid personal finance person, you immediately put $6,000 on the day that you turn 18, which, let's say it's in March. And then in April, you realize, oh, I need to actually use some of that money that I put in, so I'm going to take $1,000 out of my account. Can you actually put that $1,000 back in before the year end? And the answer is no. So if you've maxed out your TFSA for that given year and you take money out, you have to wait till the following year to be able to recontribute the exact amount that you took out. So another example, if you have $6,000 in your maxed out TFSA, you make an extra $1,000 since, you're smart and you do good trades. Now you made $1,000 profit. Well, you can take that $1,000 profit out, and then your account balance falls back to $6,000, which was the contribution limit initially given to you by the government. But since you were able to make an extra $1,000, the following year, you can actually recontribute that $1,000 plus whatever new allocated room the government will give us for that current year. So this is very good, because if you make money and you take the money out, you don't lose the room that you initially created for you by actually making those gains. On the flip side, if you put in the $6,000 and then you lose $1,000 to $5,000, and then you take, say $1,000 out, you can't recontribute to the $6,000 limit because you already lost $1,000. So you can only put up to, that extra $1,000 plus whatever the new contribution room will be for the following year. So you've kind of permanently lost $1,000 that you can put in your TFSA. So it works in both ways. It's just up to us, the average Canadian, to try to not take too risky investments in the tax-free saving account, because if you lose that contribution room, you'll never get it back. On the flip side, if you actually make a risky investment and you make a lot of money on that investment, say you double your money, it's all tax-free. So there's a benefit to taking additional risk, but you need to be well aware that if you take on that risk and you actually lose money, you won't get that room back. So this summarizes really why the TFSA is such a versatile account. You can withdraw money whenever you want. It's after tax, so it's very simple, because you don't have to try to calculate how much money you're going to get back from the government. No, it's just after tax money. Yes, it'd be great if we can get money back from the government, but in this case, they reserve that to the RSP. But you never pay tax on transactions. You never pay tax when you withdraw. So it's kind of like a much more liberating account. You have much more freedom to use the money as you wish. And if you hit an emergency, you have access to your money and you don't need to pay a penalty when you withdraw. And there's been a long-going debate between the tax-free saving account and the RSP. Should you contribute to the RSP first, or should you contribute to the tax-free saving account? And that all depends on some underlying assumptions that I'll go over in my next video, where I'm going to actually give you guys examples, dollar amounts of different scenarios where, okay, well, I'm going to invest money in my RSP initially or in my TFSA, and I'm going to make so much money in my retirement, which will then impact my marginal tax rate. And then we'll look at how these different scenarios play out given the type of account that you've chosen to invest in. But for now, guys, thanks for watching. Hope you learned something, and if you do enjoy the content I'm putting out, feel free to like the video or subscribe to the channel. It really helps me out. Thanks.